All right, let's talk Unum Group's third quarter earnings for 2025. Now, on the surface, this looked like a miss, but the stock's reaction, well, that left a lot of people scratching their heads. So today, we're going to unpack that exact paradox.
Okay, so here's the central puzzle, right? How on earth does a company miss its earnings per share estimates, yet its stock has a great day? What gives? This is the key question we're going to answer, and it's a perfect example of why you've got to look past the headlines to find the real story.
So on paper, here's what we saw. The street was looking for adjusted earnings of $2.15 per share. Unum came in at $2.09. That's a clear miss. But look at the top line. Revenue came in at $3.38 billion, blowing past the consensus. So a bit of a mixed bag, right? But that EPS number is usually the one that really matters.
And yet, this is what happened. A huge 7.2% jump in the stock price on November 4th. This is pretty much the opposite of what you'd expect after an earnings miss. So what were investors seeing that made them so bullish? Let's find out.
This brings us to our first section, where we're going to unpack this puzzling earnings pop. We need to dig a little deeper than just the headline numbers and get into the nitty-gritty of the company's business. So to really get what's going on with Unum's earnings, you have to understand this term, the closed block. Just think of it like a legacy part of the business. For Unum, it's mostly their old long-term care, or LTC policies. They're not selling any new ones, but they still have to manage all the old ones on the books. And that's where things can get a little messy. So where did that earnings miss actually come from? Well, it came from a massive one-time accounting charge tied directly to that closed block we just talked about. Let's break down what this charge really was. Here it is. This is the culprit. A $377.8 million after-tax charge to increase their reserves. This is the number that completely skewed the earnings picture. But here's the twist. The market didn't see this as a sign of weakness. No, they saw it as a smart strategic move by management. So why was it a good thing? Well, it's all about what made up that charge. This wasn't because of bad new business. It was about proactively cleaning house on the old stuff. First, they got way more conservative with their assumptions about people's health and lifespans. Second, they're actively shrinking that old block of business. And third, they're getting more aggressive about raising premiums where it's justified. Basically, they took a one-time hit to make this old business much, much less risky for the future. And you don't have to take my word for it. The CEO, Rick McKenney, said it himself. He didn't frame this as a problem. He framed it as a solution. He was basically telling investors, hey, we're taking care of this old business. It makes us stronger, and we're confident we won't have to pour any more money into it. And you know what? The market loved to hear that. Okay, so we've explained the accounting noise. Now, let's pivot to what investors were really looking at, and that's the incredible strength of Unum's core insurance business. You know, the part of the company that's actually growing. I mean, if you just set aside that closed block for a second, the core business looks fantastic. An adjusted operating return on equity of 21.4%, that is stellar. Premium growth is over 4%, and book value per share is up almost 9% from last year. The big picture here is a company that's highly profitable and growing where it counts. And if you want a real standout, check this out. The international business is absolutely on fire. We're talking 14% premium growth year over year. This shows Unum isn't just managing old problems, it has some seriously powerful growth drivers working for it. Now, this number here, 455%, is a really important one for an insurer. It's their risk-based capital ratio. Think of it as their financial cushion or their solvency buffer. A strong ratio is considered to be around 400%. Unum is sitting at 455%. That basically means their balance sheet is a fortress, which gives them a ton of flexibility. And what does a company with a fortress balance sheet and great cash flow do? It gives that cash back to its shareholders. Unum has returned almost $1 billion so far this year through stock buybacks and dividends. That is a massive vote of confidence from management in their own company. So, we've seen why the market looked right past that headline miss. Now let's turn to what management is signaling for the future and wrap up with the key takeaways for anyone watching this stock. Management was really transparent on the earnings call. They told everyone to expect another headwind of about 10 cents per share next quarter for pretty much the same reasons as this one. By setting those expectations clearly, they're building credibility and avoiding any nasty surprises down the road. So let's just boil it all down. The market saw that earnings miss for what it was, a strategic, one-time cleanup. Investors focused on the real story,
which is a powerful core business, a rock-solid balance sheet, huge returns of capital, and a management team that's smartly de-risking the company for the long term.
All right, so what does all this mean for the next quarter? Based on everything we just saw and what management told us, here's our prediction for what's coming next. For the fourth quarter, we're forecasting adjusted EPS right around $1.99. That bakes in the 10-cent headwind that management guided to. We expect their benefit ratios, that's claims paid out versus premiums coming in, to stay nice and stable. And crucially, we see those capital returns staying strong, putting them on a path to return about $1.3 billion for the full year. And for all those reasons, our rating on Unum is outperform. We think the market got it exactly right. The company made a smart move to take a short-term hit in order to de-risk its legacy business, and that's a huge positive for the long-term health of the company. The underlying strength of the core business is just too good to ignore. And that's our take on Unum's very paradoxical quarter. As always, remember this is for informational purposes only. It is not financial advice.